Hi, Mark Sorenson, Chief Executive Officer and Chief Investment Officer at Royal Fund Management. Well, the bull market is 3 years old. So, where do we go from here? I'll give you some statistics. We'll talk about last quarter and where we think we're going from here, but also some statistics that might help put it in perspective. Of the last 10 bull markets, seven of them lasted beyond 3 years, a bull market can last as long as 5 to 8 years. There has been a lot of talk about, are we in a bubble due to artificial intelligence? Are valuations too high? A lot of comparisons to 1999 and 2000 during the bubble that collapsed around the internet revolution, if you will. And so here we're in another revolution, the AI, artificial intelligence revolution, and that does typically create bubbles over time. People get too enthusiastic. We get into a euphoric situation in the market, and eventually those excesses have to be returned to normal and corrected. However, we would suggest that we're far from that at this point in time. We think there's at least another couple years, if not longer, in this bull market as AI continues to develop and actually be utilized to help build out profits and better margins going forward. Back in 2000, during the internet bubble, companies were being valued based on page clicks. There were companies that didn't even have real value at that time. Today, all but one of the companies spending a tremendous amount of money, in fact, about $2.5 trillion to date on the AI build out, are spending real cash flow. They have real earnings. They're real companies spending, not having to go into debt to build out artificial intelligence. So we think it's a much different time period. These types of industrial revolutions do create a bubble over time, but we think we're far from that. We have seen a little bit of volatility starting here in October. We actually view that as good. The fact is, we have a friendly Fed, we have earnings growth, we have about $7 trillion on the sidelines still, and we think there's enough skepticism in the market that usually the market climbs that wall of fear, and the likelihood is the market's going to go higher. That said, a normal correction, 5 even to as much as 10%, would not be unusual here. We think it would actually be healthy and build a better foundation to sustain the next move up into year end. We're in a government shutdown, and I've had clients ask me about that. Well, just an interesting statistic. In the last 6 government shutdowns, 3 months after the shutdown, the market was up an average of 6.6%, 5 out of those 6 times. So we think the government shutdown is unfortunate, but it will be resolved in time, and the market is ignoring that, focusing on growth expectations as we enter the fourth quarter, and for that matter, into the new year. Another interesting thing I said is that we have the Fed on our side. And what do I mean by that? There's still an expectation that we'll get 2 more rate cuts before the end of the year. Even Fed Chair Powell was speaking at an event today, and the market rallied on his comments, expecting that they are still on a downward interest rate trend. Historically, from any rate cut, a year later, the market has averaged an 11% gain. So that's why there's no saying, don't fight the Fed. Obviously, when interest rates were rising back in 2022, the market did very poorly, of course. But now we have the Fed on our side. The expectation that inflation, though a little bit sticky, is coming in the right direction. And with the labor market slightly weak, we think the Fed will cut interest rates. He also said something interesting today. He said that they're likely to discontinue letting their balance sheet run off. Not to get too complicated, but the Fed has been competing with the market, if you will, and letting the size of their balance sheet run off, meaning that they have less debt. If they stop that, that means they're adding liquidity to the market which will also be a positive sign. So the market still needs to broaden out. We have seen the Russell 2000, the small cap indexes have done well. In the third quarter, we saw financials and industrials do well, and we even started to see a laggard industry, the healthcare industry, start to perform better. So we believe that broadening out of the market will help as well. Right now, too much of the earnings of the S&P 500 are being generated in a concentrated way by just a handful of tech stocks. But we do think with the overall economy showing growth and the market starting to broaden out, that will also be healthy for the market going forward. So we anticipate any correction that we get now, maybe in October, sets us up for a strong finish to the year. We also anticipate that any correction will be bought quite quickly. In fact, it's interesting, we went down significantly on Friday, and yet we had a big rally yesterday. Today, we opened down, and what you're looking for from a technical standpoint is a intraday reversal. And even today, for example, we see that the dips are being bought rather than the strength being sold, which would indicate we might need to go a little lower and set on a lower bottom. The fact is we're seeing the dips being bought. Today, in fact, the Dow Jones was down about 600 points, and as of the last look was up 300 to 400 points, completely reversing the downtrend. Those intraday reversals are a sign that the dip buyers are still there. There's people that have missed the market that are taking any advantage of weakness in order to broaden their portfolio. So some volatility in October, yes, but we think the market's going to finish strong. We had a tremendous third quarter, even though September is historically the worst month of the year. We had a tremendous September and a strong finish to the quarter. A little bit of backing, filling, profit taking right now would not be unusual, but again, set the stage so we can better sustain the next move up. Earnings are likely to save the day. We had tremendous earnings from the banks today. In the next couple of weeks, we'll start getting technology earnings. We think any weakness, likely earnings and the growth seen from earnings, both at the earnings per share level and at the revenue level, will probably come to the rescue, even if we do get some market weakness in the near term. With that, I'll leave you with the rest of your day. We hope you have a wonderful day and the rest of your week, and we'll talk to you again soon. Bye now.